Hello and welcome back to All Things Money. I'm your host, David Blain. During today's show, we're devoting it to talking about the recent market volatility, especially the rise in interest rates and what the implications are for long-term investors. As I mentioned, this is not short-term trading advice. And in fact, we talked last segment about taking the advice of so-called experts, for short-term trading advice. It's just not a good strategy. And I wanted to finish up this particular part of what I wanted to cover. I covered several points for the long-term investor. If you missed it, head on over to our website, dlblain.com, and I made, 5 or 6 good points about the implications for a long-term investor. The bottom line is that if you're a long-term investor and you're focused on your goals and using the capital markets to reach those goals, it's something that this too will pass. It's not anything to be overly concerned about. But I wanted to finish with something that, just kind of a summary, that the individual investor, and I would say that to you sitting at home, I would say that to myself, I would say that to so-called market experts, but the individual investor, which encompasses everyone, is unlikely to have any particular insight into the course of global monetary policy, bond yields, emerging markets, interest rates, or things like that have not already been considered by the market in aggregate and built into the prices. And that's key. Let me say that again. The individual investor, whether you're sitting at home, whether you're, an expert, whether you're at college, academia, whether you're some politician, now unless you have some inside knowledge, that's not what I'm talking about here, but you're unlikely to have any insight into global economic policy, interest rates, what's happening in China, or anything that isn't already been considered by the global market and already in the price. That's just so key. And if you take a humble approach to the markets and say, well, yes, I don't like this running of deficits, and I don't like this printing of money, and it's bad. Okay, great. I happen to feel the same way. But to think that insight is going to give you any advantage in the marketplace and that other people in the market have not already considered that, you're delusional. And that's the point that I want to make. It's not that we can't have opinions about what things are going to happen. It's not that we can't prognosticate about it. It's that to think that you have some sort of insight that's not already been factored into the market is wrong. Even the example I used back in the tech bubble, if you rewind the clock back to the mid-90s, late 90s, when people thought the internet was going to change the world, it was not just some kooks that thought that. I mean, the majority in aggregate of people felt like the world was going to be fundamentally changed, and actually that is true. I mean, the internet has changed the world. The problem was they got a little over-enthusiastic about the prices of some of the companies involved in the internet industry, but the reality is that the aggregate market was pricing in what they felt like the future was. Now, there were certainly people that had concerns about it, and as we got to 2000, more and more people had concerns about it, and you reached a tipping point when the aggregate market, as I say, the aggregate market determined that this was not going to be, some company was not worth 300 times earnings into the future, and the market repriced accordingly fairly quickly. And so what we encourage people to do, what the individual can do with the assistance of a professional advisor, like myself, shameless promotion here, is someone that's a student of the market that, sees these things from a high up level and understands the way things work. Not we can predict the future, but we understand that you can't predict the future, and how to deal with that uncertainty is to help manage the emotions and focus on the long-term goals. Those are the two most important things that a professional can do for you. Most people go to a doctor or a lawyer or something like that, and they expect that person to be the expert in their field, medical. You want the surgeon to be the best in the field. And people get confused when they're looking to invest, and they think that somehow or another there's some financial guru out there that's just, has the secret. And it's not true. A good advisor, and this is what we focus on, helps manage the emotions of the investor and focus them on the long-term goals. Those are the most important things that you can do. If you're not doing that, if you're letting your emotions, you're reacting to something that's already been priced into the market, and the market's already moved on. I mean, that stuff that happened, Bernanke, May 22nd, when he announced it, if you're still thinking about that and you're still worrying about it, what that effect has on your portfolio, you missed it. You missed it. That information was already priced in the market. It's done with. It's over. The market in aggregate is moving on. They're moving on to other things that are happening, and they're repricing it, as we go along every day. And so I just want to encourage, people to take these events in stride. If you're not paying attention to it, there's no need to look at it on a daily basis. There's no expert that has some unique insight into, global macroeconomic policy. Certainly there are people that have, insights that in aggregate, once again, in aggregate over time lead to a greater understanding. But these new understandings are incorporated as we go along into the market prices by all the participants. Okay, well, that's all the time we have for today. I hope you enjoyed today's show. We may touch on this a little bit more again next week. But for All Things Money, I'm your host, David Blain. We'll see you again next time.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.